Hi, I am Chirag Mehta, Senior Fund Manager Alternative Investments at Quantum Mutual Fund. Today we're going to talk about the outlook for gold for 2020. Just when investors had started discounting the history and economics of holding this precious metal, it delivered stellar returns and made a comeback as a mainstream asset in 2019. Gold's rally was thus fueled by an array of mutually reinforcing factors: trade war, slowing growth, and central bank dovishness. Coming to 2020, we think that trade tensions between US and China will be a lingering headwind regardless of any positive near-term developments. The trade conflict is still unresolved given it has broadened beyond just trade. There will be continued and deepening financial fallout until the trade war comes to an equitable and fair resolution. The coming election year just adds more uncertainty and integrates further unknowns, since Trump will now be motivated to do things that add to his popularity. Amidst a backdrop of deteriorating growth and opinion polls showing a resounding defeat in 2020, in such scenario, US President Trump may be compelled to drum up a new approach in a last-ditch effort to steal back the protectionist narrative. This will largely shape up how financial markets behave, and the baseline suggests that this clash for supremacy will keep gold well supported. Coming to the US economy, things don't look very good. US economy will continue to slow down as waning fiscal stimulus is overwhelmed by the negative impact of uncertainty plagued by the trade conflict. Capital expenditures should slow as uncertainty about the US administration's policy and use of tariffs weigh on business investment and ultimately infects the job market and the consumers. We see equity markets torn between these risks and hopes that central banks will do whatever it takes to rescue the world economy with renewed monetary stimulus. If the monetary experiment embarked on by central bank over the last decade has proven anything, then it's that policy that was designed as a temporary measure due to exceptional circumstances has become the new norm. The so-called normalization process lasted only a few months in 2018, only to resume asset purchases and rate cuts by central banks. Despite the largest fiscal and monetary stimulus in decades, global economic growth is weakening, and leading economies' productivity growth is close to zero. The reflationary efforts of central banks have only given rise to more asset bubbles, like seen in the stock markets. Meanwhile, if the global economy is indeed trapped in a subpar growth environment and looming deflationary threat, then it will translate into central banks getting further aggressive in building even greater balance sheets with even greater negative consequences down the road. This could be incredibly bullish for gold. Any repricing of economic and political risk would leave investors scrambling for gold. We believe that diversification of reserves and investment into gold is bound to increase going forward in a world plagued with high uncertainty and policy irrationality. Investors would do well to remember that gold is a time-tested store of wealth and a valuable diversification tool against the numerous risks that exist in the global arena. We suggest an allocation of between 10 to 15% of one's portfolio. We suggest that investors use any corrections as an opportunity to add more gold to their portfolio or ideally keep allocating gold in a systematic manner. Thank you.